You have a 401k and you want to know, should I move it specifically into a fixed index annuity, an annuity strategy? A lot of people talk about it. I've had a couple clients in the last few weeks. It's April 2025, and you guys know it's been all over the place. The market's been up, the market's been down, it's been volatile. People don't know what the heck is going on. Where the heck should I put my money? What should I do? Is an annuity a great strategy? Well, I'm going to break that down. So, ladies and gents, just here to drop a few cents. You're here with Earl, the money coach, with a decade of being licensed in the financial industry and 2 decades of investment portfolio experience. I want to break this one down because it's been a huge topic. I pretty much had, I would say, if I had to put a number, about 35% of clients this month in April, they've been asking about this. What can I do about my 401k? Because unfortunately, for a lot of you watching this, 401k is the primary way for most people to save money. So I'm going to break that down. If you should, the pros and cons, what is a fixed index annuity, and how all that works. But before I do that, make sure you like, follow, and subscribe, and click on the description below where you can get your health savings account started, instant approval on insurances, and for you business owners, you could get 6 figures of loans approved to help catapult your business. So, first and foremost, why should you move your 401k into a fixed index annuity? The main thing is your 401ks are volatile, they're variable accounts. It could go up, it could go down. With your fixed index annuity, you have an index portfolio and an index style of strategy, which means you have a floor and you have a cap. When the market drops like it did this month, you have a cap. You can never go underneath. And the cap is generally zero. So zero is your hero. While if you had your 401ks, your IRAs, mutual funds, or anything on the more volatile side, it's been a rough month. You've seen it go up, you've seen it go down, all those different things. So, first and foremost, fixed index annuities give you that protection of having a floor, and specifically a fixed index annuity. You have a lot of different annuities out there. There's a lot of good and bad in the market. You need to make sure you know exactly what you're talking about. And what do I mean by that? Which one are you looking at when you're discussing if it's a good fit? In today's case, I'm talking about a fixed index annuity where you could capitalize and be a reflection of the market. So you could capitalize on some of the gains, but you're not participating in any of the losses. Now, that's huge when you're comparing what you could do with your 401ks and your fixed index annuities. Now, the second main thing to understand is your 401ks is generally through your job as you're paying. Every time you get paid, a certain amount comes out your paycheck that goes toward your 401k. Your fixed index annuities in general is a one-time lump sum kind of payment. So you got $100,000 you put into an annuity, you let it ride off in the sunset. You have a 401k, you want to do a rollover, because the way you do this, moving a 401k to a fixed index annuity, is by doing a rollover. So you could roll over money into an annuity and let it ride out. A lot of annuities, myself, I'm a broker, I have over 50 companies I could use for annuities, but there's only 1 or 2 companies out there on my platform, at least, where you could continuously put in money for a certain amount of time. It may be so in the first 12 months, you could dump in as much money as you can, then you're locked in. But generally speaking, most annuities are one time lump sum, and you put it into a fixed index annuity and let it ride off into the sunset. Now, a huge part of this is, how do you move your 401k? Well, I got good news and I got bad news. The good news is, yes, it is possible to roll over 401ks into different kind of strategies. You just need to know about taxation, how it's taxed. I'll cover that later. But the bad news is, not everyone could do it. Not every company allows you to do this. It's because, specifically speaking, it's a strategy that the company has to elect if they allow you to move your 401k to another strategy. Now, that's what we call a in-service distribution. In-service distribution pretty much means that, hey, while you're still working at this company, you are allowed to move that 401k from your company's 401k into a different kind of strategy. Reason why this is important, because by law right now, if you are currently working at a company, you cannot move your 401k. If it's an old 401k, no problem. If it's a 401k that's limbo, don't know what to do with it, if you're in between, transitioning between jobs, no problem. But while you're currently working at your current job, it's called a in-service distribution if they allow you to move your 401k into another kind of strategy, or as we're talking specifically in this video, a fixed index annuity. So you have to see that. In my career time, I've been here for 10 years, licensed helping people. I've only seen it 3 times. 3 companies allowed their clients, not their clients, their employees, to be able to move their money from a 401k in service distribution into something else. If it's an annuities, mutuals, IULs, IRAs, whatever, anything out there, very few companies, because it doesn't benefit necessarily the company, you know. So you got to look at it that way. So that's huge. Now, taxation is big when it comes to moving your 401ks to different strategies. And the word you're looking for is qualified. Either is qualified or non qualified. Now, it means exactly what it sounds like. Either you're qualified to pay taxes or you're not qualified to pay taxes when you're moving your 401ks. Now, I'll give you an example. Qualified means, look, you have money, you haven't paid taxes on it yet, like most 401ks. That money's been tax deferred. So your 100,000 in your 401k is grown tax deferred. So that means since you haven't paid taxes yet, it is a qualified plan that qualifies to pay taxation on that principal. So if you have your money in a 401k, you want to move it somewhere else. If it's qualified, that means you're going to take the taxes out. And generally speaking, on what it is, in this case, your fixed index annuities, you can have multiple options. Regularly, option A is I got 100,000. I want to pay the taxes on it today, right now. I'm at a 24% bracket, so that 100,000, take out that 24%, roll over that last 76 grand. I'm good to go. Option B is move that whole 100,000, let all that grow, and then when I want to start utilizing and withdrawing or loaning that money to myself, then you're going to pay a little bit of taxation on the principal. So that's what's called qualified. Now, your non-qualified is exactly what it sounds like. You're not qualified to have to pay taxes on putting that money, specifically in a fixed index annuity. So you got 100,000 in your bank. That money's already been taxed when you got paid or whatever you're doing. That 100,000 has already been taxed. So that's not qualified to be taxed again. So if you move your money from your bank account, a settlement, whatever you may have, whatever's under the mattress, you know what I mean? You move that into a fixed index annuity, that is non-qualified, meaning it's not qualified to be taxed. So you need to remember that even if annuities aren't for you, if you're looking to move your 401k, what kind of taxation is going to happen on the principal? That's huge. Now, the difference between a 401k and your fixed index annuity is fixed index annuities are tax advantage strategies. So all your money that's in there, the growth is 100% tax free. That's right, folks. All that money gets to grow tax free inside your fixed index annuity. So if you have $100,000 that you roll over, that 100,000 goes to 500,000, while that $400,000 of growth that grew tax free. One of the best strategies out there. Now, the reason why I talk a lot about fixed index annuities because it's one of the safest ways where you could actually create a personalized retirement for yourself. I always call it your private social security. A personalized social security. When you normally get paid, right? You get paid, a little bit comes out for your social security, some comes out for your 401k, your medical, all that stuff. But generally speaking, a certain amount comes out your social security, and then everyone gets access to that. Well, in a fixed index annuity, you're putting that money in for yourself, and then you could turn on one of the options where you could withdraw and receive tax-free income and lifetime income for the rest of your life, even after the principal and the growth has ran out. So you could create your own social security, your own kind of pension with the fixed index annuity, something not a lot of strategies allow you to do because you run out of money. Because remember, folks, wealthy people don't live off the money, they live off the interest their money makes. And a lot of your fixed index annuities are averaging anywhere from 8 to 10%. Some could be doing a little bit more, some could do a little bit less. But ideally, if you're averaging 8 to 10%, you're way past what you should be living off. Because right now, the general saying is you should be able to live off 4 or 6% of your retirement on that interest monthly for your lifetime. So you need to accumulate enough wealth to be able to have 4% or 6% coming out so you're good to go. Well, your annuities are doing regularly more than that. So you know it's something that could provide that lifetime income. So that's a huge thing. But now everything else, when you talk of fixed index annuities and 401ks, a lot of stuff are the same. You have to wait to 59 and a half to access your funds and all that good stuff. But a huge thing people ask is, all right, I know fixed index annuities grow tax free, but how do they make their money? How is that possible? Well, there's something called a surrender charge, which unfortunately not a lot of agents talk about. The surrender charge is literally what it sounds like. If you surrender the strategy, because fixed index annuities are a contracted time allotment of a time you're having money in something. Meaning, when you have an annuity, you have to have it for a certain amount of time, 5 years, 7 years, 10 years, no, 14 years. They have a lot of different time frames. So if you have a 7 year annuity, you need to keep it for 7 years. You have a 10 year annuity, you need to keep it for 10 years. If you start to want to surrender anything, the penalties, generally speaking, the length of what you have, and then it diminishes. Meaning, if you have a 10 year fixed index annuity, generally it's a 10% penalty or 10% surrender charge starting off up front, and then it'll start to drop down. So if you have 10 years, year one is a 10% surrender charge, year two is a 9% surrender charge, 8%, 7%. So it kind of starts to go down over time. So you have to remember that. But a good thing is you're allowed to take out yearly, depending on your company. Every company is different. Depending on your companies, most annuities and fixed index annuities allow you to take out a certain percentage. A lot of them are 7% or 10% every year penalty free. So if you do need to have access, you have an emergency, something happens, you could take, depending on the company, whatever their percentage rate is. So that could be huge. If you got $300,000 in your annuity, they allow you to take out 10% every year penalty free. You still got access to 30,000 if you need to do something. You have an emergency, whatever the case may be. So you can have that feature as well, which is huge, instead of just having a penalty if you have a 401k, if you have a hardship or a struggle or something you need to take care of. So that's a huge benefit. And I tell people one of the cons are, because it sounds too good to be true, I know, but it's not too good to be true. It's too good to be true. It's too good to be free. That means there's going to be a downside. There's going to be a cost to it. And the cost of your fixed index annuities are, it's not a get rich quick, it's a get rich slow. This is something that's geared for retirement. You don't put it in now and in 2, 3 years you think you're going to double, triple your money really quick. Use it right now. No, they're set more as a long term strategy so you could provide yourself supplemental income. Supplemental income is exactly what it sounds like. You have an account, you're pulling out X amount of dollars every year to supplement what you were making while you were working. Understand this, folks. Any strategy you hear me talking about is not supposed to be your sole retirement strategy. It needs to be supplemental income, just like a 401k. 401k was never designed to be a primary resource for retirement. Same thing with Social Security. It wasn't designed to be the primary source of retirement. But right now, over 80% of people, that's their only source of retirement, Social Security. No, you need to make it a supplemental income. You have a little bit coming from Social Security, a little bit from your 401k, a little bit from your mutual funds, a little bit from your savings, a little bit from your fixed index annuities. All these different things create a supplemental income which you could use for your retirement. So when you're looking at your fixed index annuities or moving your 401k into annuities, you're not doing this to be your sole purpose and your sole retirement, but a huge portion where it could be a supplemental income with a guarantee of not losing your money. That's the big thing. Most of my clients, when they move their 401ks into annuities, is hey, I'm getting closer to retirement. I cannot risk my money being a volatile account where I can have a drop. I want to have that floor, that index floor where I'm good to go. So that's a huge thing for a lot of folks when they look at moving their 401ks into annuities. But the best part about it is what we call a bonus. Not every company does this, but a lot of companies do have bonuses when you start investing or moving your money into your annuity strategies. There's difference I've seen from 10%, 12%. I personally, on my platform and what I could do, I could give someone a 25% bonus on their annuity. They may not qualify for it. You have a lot of suitability and see what you could do with certain companies, but you do have. I just gave a gentleman 20%. He had a 500,000 day one that he put in. I give him a 20% bonus. So he started with 600,000 principal day one with that bonus. So the bonus could be huge. It could be something to bump up what you have in your annuity, but the bonus also could be something to offset. Hey, I'm going to have to pay 20% because that's how much I have in taxation in my 401k. Well, if you got to pay 20%, you could use that bonus from an annuity to offset that difference, and you could keep going like nothing happened. So that could be a huge strategy. Now, understand, folks, I'm not saying that this is the only thing out there, but it's a great way to move your money from a 401k that could kind of have limitations. Because remember, 401ks, you can only put in a certain amount, you can't touch it for a certain time. And if you leave the money in there too long, you have a RMD, which means required minimum distribution, which right now is 73 and a half. So what they're going to say is, hey, you've had your money in this 401k for all this time. If you don't start using this money, we're going to tax and penalize you more. And that could be up to 50%. So it could be more than you regularly were supposed to pay. So you have a lot of stipulations in your 401ks, whereas in your fixed index annuities, you don't have as much. So I always say if you want to check out more on how fixed index annuities work, definitely check out the rest of my channel. If you want to find out the pros and cons on your 401ks, check to see what else I have. But if you're looking for some way to have a 401k move into a safer, more structured strategy, fixed index annuities can be the way to go. But you need to sit down with a licensed professional that knows what they're talking about, not these social media gurus, these influencers. You want a licensed professional that knows what you're doing, because one of the major cons are if you don't know what you're doing, a fixed index annuity could be putting you locking your money in for a specified amount of time you're not looking for, and that could be a huge mistake. So you want to make sure you're doing it correctly. You know the pros, the cons, the surrender fees, all that kind of stuff. But if you first want to know if you could even do a rollover from a 401k to a fixed index annuity, go to your job, go to HR or your benefits specialist and talk if there's a way I can move my 401k if you guys offer in-service distribution to let me take care of that. So if you enjoyed the video, make sure you like, follow, and subscribe. And once again, click on the link in the descriptions below where you could get your free budget, your health savings account started. If you're looking for life insurances, get instantly approved. And my business owners, you could get 6 figures of business funding approved on the links in my description. And I'll see you guys on the next one. Take care.